Kia ora, and welcome to the CoreLogic Property Market Update for Haki here, December 2023. The Aotearoa property market gained a little bit of momentum in November, but it's likely summer holidays could temporarily stall that momentum as many Kiwi, particularly investors, are likely to wait until the new year to make any big financial decisions. Housing values increased by 0.7% over November, after rising 0.4% in October. This is a stark contrast from the recent fall of 1.2% in June this year. Meanwhile, it looks like our main centres have started to properly bounce back from the downturn. Tauranga is the only main centre where values are lower now than they were 3 months ago, while Otipoti, Dunedin values have grown 2.9% over the same period. From our other main urban areas, Porirua and Tairewhiti, Gisborne are the standout performers, up 4.9% and 4.8% respectively since the start of September. Kapiti Coast and Ngā Motu, New Plymouth though, despite increasing in November, remain 1.9% and 1.4% respectively down over that time. This regional variability will likely continue to be a feature of the market throughout this phase of the cycle, so it'll pay to keep an eye on local trends. From a broad perspective though, we do expect the housing values and activity to gradually trend higher from here. Property listings will be one metric to watch in the new year. With the summer break on the horizon, prospective vendors are likely to opt to wait if they haven't previously been successful and aren't motivated to sell. 2023 was a consistently quiet year for properties going to market, but with confidence now returning, we expect the flow of listings to trend higher in 2024. This could be assisted by the shortening of the Bright Line capital gains test, as we expect the new government to do. Most discussions surrounding housing policy changes have been focused on the potential impact on demand, which makes sense as they're generally favourable for property investment. But for some investors carrying larger debts and making significant weekly top-ups to their properties, they may look to divest an asset or two. Assessing the scale of impact to demand isn't straightforward. However, we don't see the faster reinstatement of interest cost deductibility as being a game changer. This is mostly due to property investment profitability calculations being hindered by the combination of high prices, low rental yields, and relatively high interest rates, not the tax treatment of interest costs. This affordability crutch, which also applies to owner-occupier activity, will serve to keep a lid on overall demand through the year and could see capital growth limited to roughly 5% over the year, a figure much more in line with income growth than historic rates of house price appreciation. Add in the likelihood of debt-to-income limits being imposed by the middle of the year, and expectations for the year of constrained growth become that much clearer. We are forecasting a modest increase in sales volumes, which will be welcomed by anyone who sees business boosted by real estate transactions. Yes, this includes real estate agents, but translates through any industries directly or peripherally affected by housing sector activity, including banking and finance, moving companies, insurance firms, conveyancers, valuers, and especially the development and construction industry. We'll certainly be paying close attention to the activity of owner-occupiers moving house next year, after they've previously sat on their hands through uncertain times. Increasing debt during a time of high interest rates could continue to hold them back though, and first home buyers will probably continue to find a way into the market, especially with rental prices growing at near record rates. From a monetary policy perspective, we expect the Reserve Bank to remain cautious in loosening too soon, as they stay strong in their fight to get on top of inflation, which is still running high. They will keep the OCR at current restrictive levels, and with it, interest rates will hold roughly steady. The Reserve Bank knows they can stimulate the economy when required by cutting the OCR, and the market is relatively reactive, so best to remain prudent and do it too late than too early. For anyone in the industry then, we're preparing for a much more normal year than we've had recently, but stretched affordability is going to be the defining factor, as clearly illustrated by the share of income required for mortgage repayments, hovering around 50%, with no major improvement in sight. For a full review of the year gone by and a preview of 2024, check out our Best of the Best report, which also evaluates the performance of every suburb across the country on a number of different measures. And to keep across every new development in the market, follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Have a safe and relaxing holiday season. Mā te wā.